The stock market triggered a signal back in January of 2023 that we've only seen a handful of times since the 1960s, a signal that actually tends to produce extremely attractive returns in the 6, 12, 18 months after the signal is triggered. 6 months out, we have stocks yielding better than average returns 90% of the time, and 74% of the time 12 months out. We're around 6 months out from the signal that was triggered on January 12th of 2023, and we actually see that the market is up 11%, which is actually exactly what the signal predicted back in January. If you look at the average returns of stocks following this signal 6 months out, it's around 11%. That's what we've seen over the past 6 months. If this signal continues to prove accurate over the next 6 months, the market could be back up above its all-time high within the next year. But on the other hand, you have this signal that was triggered in very peculiar circumstances, triggering right after one of the most aggressive Federal Reserve tightening cycles in history. We've never actually seen this signal get triggered in these circumstances. So that's exactly what we're going to take a look at in this video, whether or not we should expect this signal to prove accurate once more, or whether the tough macro conditions that we have today are going to prevail and make this signal fail. Welcome back to Game of Trades. I hope you guys are going to enjoy this video. If you do, don't forget to click on the like button and subscribe to the channel if you have not already. Now, without further ado, let's get right into it. I do want to remind you, this is the last chance to get the deal that we're doing on all our plans for the 4th of July. We're doing a 20% discount on all our services. We really provide the information, the research that investors need to navigate all types of macro environments and get investment ideas with extremely attractive risk rewards. Now, the signal that was triggered back in January of 2023 is actually called the Walter Deemer signal, and it's actually extremely simple. It just takes the number of stocks that have been moving higher over the past 10 days minus the number of stocks that have been moving lower in the past 10 days, and it gives you a reading based on that. And it oscillates up and down. When it's up, the market breadth is strong, there's lots of participation, and that tends to be a bullish signal for the market. When it's very low, it means most stocks are trending down, and it triggered right here on January 12th. Now, if you actually take a look at what the S&P 500 was doing here, it wasn't that impressive on January 12th. It was right here. But if you look at the RSP, the S&P 500 equal weight ETF, as opposed to the cap-weighted S&P 500, so taking out the bias that you have from the big mega cap stocks that make a big portion of the S&P 500, well, you actually had a very strong market back on January 12th when this signal was triggered. So that was really telling you the market performance leading up to that signal was strong. Lots of stocks were participating in this rally. It was actually up around 20% off the low, triggering this signal on the Walter Deemer indicator. And as we discussed at the beginning of this video, it yields extremely attractive returns looking out 6 months, 12 months, 18 months. Stocks in most cases yield better than average returns, and by quite a big margin. 11% return 6 months out, 16% and 19% return 12 months after the signal is triggered. And this chart actually puts all of these signals throughout history, and it is quite impressive. The green dots are actually all the instances where the market managed to yield better than average returns, but even the failed signals weren't that bad. Look at this signal here in December of 1970. The market was still up 4% 12 months later. Same thing goes for the signal that was triggered in 1992 and July 2009 right here. So that was a very interesting signal that we had back in January of 2023. And when you look at the S&P 500, the cap-weighted S&P 500, it's actually followed that very closely, yielding 11%. 6 months out. But when you look at the S&P 500 equal weight ETF, so you actually look at the majority of stocks on an equal weighted basis, the signal produced negative returns 6 months out. So that's already quite a difference from some of the signals that we had throughout history, that most stocks here have actually been trending lower over the past 6 months. In fact, if you look at the performance of US stocks that don't have AI exposure, and you look at that since ChatGPT was released, we've actually seen stocks that are not exposed to AI being almost flat since that date. So the question is now, should we expect these great returns over the next 6 months that the historical data suggests we should see, with potentially an additional 8% gain from current levels in just the next 6 months. Well, if we look at the typical macro environment in which we see these types of signals, they actually do tend to be produced when the Federal Reserve is lowering the Fed funds rate. This is a chart of the Fed funds rate on a year-over-year basis, and you see all the dots here are when the signals were triggered relative to what the Fed was doing, and in almost all the cases, you see that these signals are triggered when the Federal Reserve has been easing monetary policy over the last year by lowering the Fed funds rate. We've actually never before seen a breadth participation signal trigger when the Fed has been tightening very aggressively, like in 2022. And that makes sense, right? When the Fed eases monetary policy, it lowers the Fed funds rate, it stimulates the economy, it creates an economic boom where stocks can begin to price in economic growth, earnings growth, and really trigger a bull run. When the Fed raises interest rates, you get the exact opposite effect. It slows the economy down. You're more likely to get a recession. You can see the gray bars here are all recessions. They tend to occur after the Fed has been on a big tightening cycle, like here in 1969. 1973, then the Fed eases monetary policy, and you get the breadth signal when stocks begin to see past the recession and begin to price in the economic recovery. In fact, if we take a look at those signals against the yield curve, in almost all cases, you have this signal trigger when the yield curve is steep. A steep yield curve means short-term interest rates are lower than long-term interest rates, and so that makes it easier for domestic banks to lend out money because they borrow at the short end and lend to people and businesses at longer-term interest rates. So the yield curve is a great way of looking at how tight monetary policy is, and a steep yield curve is again a sign that monetary policy is easy, and an inverted yield curve is a sign that monetary policy is tight and you're more likely to get a recession. Again, the recession bars here often occur right after a yield curve inversion, a period where monetary policy has been tight. What's very interesting is that we've only seen one case where the yield curve was inverted and the Walter Deemer indicator produced a bullish signal, and that was in 1967 here, where it did trigger with an inverted yield curve. And if we look at forward returns after 1967, 6 months out, 9% return, and 19% return 18 months out. So again, a successful signal. Arguably, you can say that the yield curve was only slightly inverted, much less than today, and was only inverted for a very brief period of time. What's interesting is that we actually saw stocks bottom at the very same time as the yield curve bottomed and began to steepen. And this yield curve inversion that we had in 1967 never triggered a recession. So you never had the slower growth environment that typically follows when the Fed has been on an aggressive tightening cycle. Since 1967, we've never seen a yield curve inversion not trigger a recession. That has happened every time. Of course, sometimes it takes a bit longer for the recession to play out, like in 1989, where it almost took 2 years for a recession to play out. And same thing in 2006. You had a very slightly inverted yield curve in 2006, and the recession only began around 2 years later. And of course, that was a very severe recession. So on one hand, you have a breadth signal with an almost perfect track record at predicting better than average market returns in the 18 months that follow. But on the other hand, you have a macro signal from the bond market that also has an almost perfect track record at predicting weakening economic activity and recessions. Both of these signals have never triggered at the same time, at least not with the yield curve this deeply inverted. So this really comes down to the individual investor's belief whether or not the inverted yield curve will prove to be an accurate signal at predicting a weakening economic backdrop this time around. If you don't think that's the case, then 1967 is a beautiful example of that, and the Walter Deemer breakaway momentum signal forecasts that equity returns in that type of macro environment are strong even in the next year, suggesting that stocks might actually only be halfway through their 18-month rally. Now, our opinion is that macro forces will prevail and negate the bullish signal. Now, our opinion at gameoftrades.net is that macro forces from a very tight monetary policy are going to hit the economy in relatively short order, and stocks are going to begin pricing that in, negating this bullish signal at least over the next 12 months. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to click on the like button down below. and subscribe to the channel if you have not already. Now, in the meantime, I wish you good luck on your trading and see you next time.